Michael Aronstein, President, CEO, and Portfolio Manager at Marketfield Asset Management. His long-short Marketfield fund was in the top 9% of its class last year, beating both the Dow and the S&P. Let me ask you what you think about what Scott's saying, what you think about earnings here, the U.S. equities picture.
I think he's right. I think ultimately earnings do drive equity market results, and I think this market keeps surprising people in terms of how resilient not only the market is, but the corporate sector. Now, the economy is mixed now. We have a new leadership in this cycle, and it's sort of U.S. manufacturing, which hasn't been in a leadership role for several generations. So I think people are paying a lot of attention to the legacy problems of the last cycle, and among those are things like governments which have really overspent their means, the banking system, which has a lot of residual issues, housing. But those are not going to provide the leadership in the cycle that we're in. Every cycle is characterized by a change in the character of the leadership. And just like when we came out of the recession in '02, people looked back and said, well, technology is still mired in a slump, except that it was housing, emerging markets, and commodities that led the entire cycle going forward. That's not where the attention was. And I think a similar thing is happening here with the U.S. corporate sector, particularly in manufacturing.
While we're on the subject of this cycle, I want to go over to Adam right now. GDP was revised up today. That's a big deal, and it was actually more than expected. Adam?
Oh, yeah. Well, I'll tell you why it really is a big deal, because it got back above 3%. Remember, it had been revised now to 2.8, and there was a lot of concern that once you factored in higher oil prices, it might even go lower still. You're looking at it right there. So that 3.1 number, that's the one we got today. It's a third bar over. And the key is looking at the estimate 3.4. Now, no one has revised that down yet to below 3, because you might have thought that, again, given the oil prices. But if, in fact, GDP can stay above 3%, it makes the case, Michael Aronstein, does it not, that you're going to have the job growth here?
Yeah, I think at some point you will see the hiring mechanism kick in. I think first you're going to see a real acceleration in capital spending on the corporate side. And I think beyond that, you will see hiring begin to catch up. And I think when some of the political uncertainties and maybe regulatory uncertainties are resolved, that'll pave the way for it.
Are you concerned about the external factors that we are confronted with? It seems they continue to build, they continue to get worse. Europe could be in a world of hurt if Spain needs a bailout, if Italy needs a bailout. The Middle East doesn't seem like there's a huge leadership position being taken. The right goals are being set in Libya. And the Japanese nuclear crisis, which for a moment seemed to be getting better, now seems to be getting worse.
Well, all of these things are worrisome but not determinative in terms of the corporate profit picture, not only here but around the world. What you're seeing really, I mean, all these I would put in the context of a long-term restructuring of government, which is not even passed into the 21st century yet. And the problems in the Middle East, the problems with U.S. states, the problems in the entire Eurozone are various aspects of this one big overriding problem, which is the necessity to restructure governments that are way out of date. In some cases, they're only 20 or 30 years behind the time. In other cases, they're centuries behind the times.
Michael, it's Sheila Dharmarajan here. I want to get back to your manufacturing thesis for a second. You talk about manufacturing leading this cycle, but everything that U.S. companies are manufacturing are all for countries outside all the emerging markets. And we had Caterpillar with a lot of headlines this week saying they're so excited about the Chinese and Russian and Indian markets. How does that impact your thesis and your thoughts evaluation here?
Well, I think in general, you have a world that has a more durable consumption base now because of the rise and reliquefaction of the emerging markets. And I don't think that's something that's going to go away. American companies, for the most part, are very, very well positioned to take advantage of it, particularly with the dollar being where it is. The U.S. has a cost advantage in a lot of aspects of commerce at this point. When you hear that New York is now not even in the top 20 of office space rental costs in the world, that seems a little bit of a distortion. And I think when you look at, say, the cost of land acquisition in the Midwest and our transportation infrastructure, plus the fact that I think the Japanese events have refocused people on some of the risks of the supply chain. And the U.S. is still the main venue of global consumption, but with the supply chain risks where you're sourcing things from around the world and you're really, really dependent on logistics, there may be something to be said for taking some of the resources and placing them at least in a backup position in a just-in-case mode in the United States. I think you're going to see over the next several months the disruptions out of Japan are going to impact a number of companies, some very severely. So I think that may give corporate risk managers another thing to think about. And the answer, of course, in the case of domestic corporations, is to move some manufacturing capacity, or at least have the capability to move it back to the United States.
What do you think about the strength of the U.S. markets here? I mean, do we look better relative to other markets?
Yes, I think our market definitely do, because the monetary cycles around the world are asynchronous right now. You have the developing markets, and India is a good example of it, much more concerned about inflation and with very, very tight and tightening central bank policy. You know, the yield curve, in effect, in India is inverted at this point. And you still have our Federal Reserve treating the U.S. economy as though it's on the brink of another recession.
Will our Federal Reserve continue that? Do you expect more accommodative policy here? I
think we're beginning to hear the change of tone right now. They're starting to whisper about the fact that maybe the risks that they saw 6 months ago aren't for real. And in actuality, my guess would be that before the summer, you're going to see a lot more aggressive talk out of the Fed as some of the final worries go by the wayside.
The Fed gets more hawkish.
Yeah, and I think they're very late on this. They should have followed through last April, really, and allowed short rates, at least, to begin some process of normalization. You know, 25 basis points, to my mind, is a ridiculously low rate.
Great. Michael, thanks so much for getting some time with you. Michael Aronstein.